Okay, you're set. You watched my video about investing your first £100, you built up your emergency fund, and you have your knowledge and expectations set, and now you have £5,000 to invest. But now what do you do? Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discussed is intended for information and educational purposes only, and should not be considered investment advice or investment recommendations. Just like when we were looking at the £100, the approach you can take to invest can vary significantly based on your individual circumstances and objectives. In this video, we'll explore the key factors to consider when investing this sum, including setting your goals, understanding risk tolerance, determining an appropriate portfolio composition, and avoiding common investment mistakes. Now let's proceed with determining your goal before asking how to invest, as the answer will be situational depending on what your goal is. What is your goal? The first and most important step in investing is to decide what you want to achieve. Without a clear goal, you'll be directed into different strategies that might not suit your comfort in investing and might end up losing a big chunk of what you had invested due to panic selling or lack of confidence. It's not easy to choose the right way to invest, but setting your goal will help you pick the right types of investments and help you decide how much risk you can handle. Here are the different types of goals or time horizons you may want to consider. Long-term wealth building. If your primary aim is to grow your wealth over a long period, such as saving for retirement or building a significant nest egg for the future, you might focus on investments with higher growth potential. Stocks, particularly those in growth sectors or emerging markets, can offer substantial returns over decades. For instance, investing your money and waiting 10 or 15 years or more before withdrawing is what we refer to as long-term wealth building. Maybe you have a shorter time horizon than retirement or a slightly lower target value, so next is medium-term savings. For goals like purchasing a home, funding education, or a significant life event that's about 5 to 10 years away, a balanced approach is often recommended. This could include a mix of stocks and bonds or other lower-risk assets, offering growth potential while mitigating some risk. It is what's generally called a moderate risk. Short-term objectives. If you need the money within a few years, preservation of capital becomes more important than high returns. In this case, lower risk investments such as high yield savings accounts might be more appropriate. For example, you want your money to stay in the right value, so you invest in these low risk investments or savings accounts just to beat off inflation. Also, you can get your money back in a short span of time for immediate use or other purposes. As I make this video, Trading212 is offering 5.2% on GBP cash that you leave uninvested within the platform. This could be a good way to keep your cash preserved for shorter time periods while still getting a pretty decent return on it. On top of that, I asked Trading212 if they could give me a unique code that you guys can simply type into the promo code section, capital at risk. So if you've opened up a new account recently or planning to open an account, then here it is. DivExp or DIVEXP, short for the Dividend Experiment. So you have 10 days from opening your account to type this in and receive shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. If you do use it, thanks for your support, and thanks to Trading212 for sponsoring this video. Another goal that isn't so much based on the time horizon, but more what you want your money to do, and that's passive income generation. Some investors seek to generate regular income from their investments, which could be used to supplement their salary or pension. In other words, the motto of this channel, build a portfolio that pays your bills. Dividend-paying stocks, real estate investment trusts or REITs, and bonds can provide pretty steady income streams. For example, investing in dividend-paying stocks will give you a monthly, quarterly, or annual payouts, depending on the frequency the company pays. The idea is that investing your capital on certain stock that gives out dividends and earns regular income depending on the dividend yield of the company you've chosen. So now that you have your goal, you also have to bear in mind your ability to watch your money go down, as is the case with all investments. Risk and tolerance. Knowing your risk appetite or risk tolerance is actually super important in crafting an investment strategy that will align with your comfort level and financial situation. Because if you determine your risk appetite, you'll be able to control, within reason, how much you can lose and how much you can gain. Several factors influence risk tolerance, including age, career stability, and personal financial circumstances. Age. Age can play a significant role in determining risk tolerance. Younger investors typically have a longer time horizon, which in theory allows them to take on more risk, since they have more time to recover from potential market downturns. For example, a 25-year-old investing for retirement can afford to allocate a larger portion of their portfolio to stocks. In contrast, someone nearing retirement might prioritize preserving capital and generating income, favoring bonds and other lower-risk investments. Career stability. The stability and predictability of your income can also influence your risk tolerance. Individuals with secure jobs and steady income streams might feel more comfortable taking on higher risk investments. Conversely, those with variable income or uncertain job prospects might prefer a more conservative approach to ensure they have the accessible funds in case of emergencies. Personal financial situation. Your overall financial health, including your debt levels, savings, and emergency fund, affects your ability to take risks. If you have significant debt or lack an emergency fund, it might be wise to address these issues before investing heavily in high-risk assets. Assessing your risk tolerance requires honest self-reflection. Tools such as risk tolerance questionnaires can help gauge your comfort level with different investment scenarios. Portfolio composition. A portfolio composition or allocation simply means how you'll invest your money in a way befitting your objectives, risk appetite, investment style, and the right strategy in executing it. A well-diversified portfolio can help manage risk and improve potential returns. Here's a breakdown of the different things you might allocate £5,000 to across different asset classes, depending on your objectives. So first is stocks. When you're thinking about adding stocks to your investment mix, your main goal is to grow your money over the long haul. However, it's important to recognize that stocks can be risky. Start by figuring out how much risk you're comfortable with and how long you plan to invest it. If you're okay with taking on more risk and you're in it for the long term, that means not under 5 years realistically, putting more of your money into stocks might make sense. Do your homework on individual companies, understanding what they do, how they're doing financially, and if they're likely to grow. To lower your risk through diversification, spread your investments across different types of businesses. You can also consider investing in index funds or ETFs that track big groups of companies, like the FTSE 100 or S&P 500, or even an all-world or global fund. These can help reduce your risk because they invest in lots of different companies. You can choose between growth stocks, which are expected to grow quickly, or value stocks, which are priced lower than you think they should be and can provide more steady returns. Bonds. Adding bonds to your investment mix is all about making your portfolio more stable and getting regular payouts while still making room for riskier parts like stocks. First, decide what you want to achieve with your investments and how much risk you're willing to take. Bonds are generally safer than stocks, but they're not all the same. Government bonds like UK gilts are usually the safest because they're backed by the government, and corporate bonds can give you higher payouts, but they come with a bit more risk because they depend on the companies issuing them. Bond funds are another option. These pool money together from different investors to buy lots of different bonds, giving you a more balanced mix. Figure out how much of your portfolio you want to put into bonds based on how much risk you're okay with, and what you want to achieve with your investments and what's going on in the market. I would personally prefer to invest in a diverse bond fund and individual bonds, just to avoid the assessment an investor would need to do to invest in individual bonds. Cash and cash equivalents. Having some cash or cash equivalents in your investment mix is like having a safety net for emergencies, and then being able to grab hold of new opportunities when they come along. Start by deciding what you want to do with your investments and how much risk you're comfortable with. Then look at how much cash you might need in the shorter term. This is separate to or after you've accounted for your emergency fund. You can put this portion of your portfolio into things like savings accounts or money market funds. You just have to make sure they're getting a competitive rate. In the spectrum of things you can invest in, these are all pretty safe and easy to get to when you need them, i.e. they have high liquidity. So how does it actually look? Now, the concept of dividing up your portfolio might be a little hard to visualize, so I found some examples here from Hargreaves Lansdown. Cautious portfolio. This is designed for risk-averse investors, and this portfolio focuses on capital preservation. It primarily includes investment-grade bonds for stability and steady income, with limited exposure to overseas and UK shares for modest growth and a small portion of other bonds for added diversity. Balanced portfolio. This portfolio is ideal for investors seeking a mix of stability and growth, and this portfolio balances investment-grade bonds for steady income with a significant portion of overseas shares for global growth. It also includes moderate exposure to UK shares and a small amount of other bonds for diversification. Moderately adventurous portfolio. This portfolio suits investors willing to accept higher risk for greater returns. It heavily emphasizes overseas shares for growth with a substantial UK shares exposure. It maintains some investment-grade bonds for stability and includes a small portion of other bonds for additional diversification. Adventurous portfolio. This one is aimed at risk-tolerant investors seeking maximum growth. This portfolio predominantly features overseas shares. It includes a small allocation to UK shares and minimal investment-grade bonds, focusing primarily on equities for high return potential. Common mistakes that people fall into. Even with a well thought out plan, investors can make mistakes that undermine their success. Getting the ideas of the common mistakes will make you look ahead in time and avoid what you need to avoid to achieve your goal. Here are some common pitfalls to avoid. Lack of diversification. Investing all your money in a single stock or sector increases your risk significantly. Diversification across various asset classes and industries helps mitigate this risk. For example, if one sector performs poorly, others may perform well, balancing your overall portfolio. If you focus on one single stock and that company collapses, you might end up losing all your money or your capital. Timing the market. Trying to predict market movements often leads to buying high and selling low. Market timing is notoriously difficult even for seasoned investors. Instead, focus on a long-term investment strategy and remain consistent with your contributions. Some say that the key to successful investing is not by timing the market, it's about planning and achieving your goal step by step. Emotional investing. Making investment decisions based on emotions rather than logic can lead to poor outcomes. Fear and greed are powerful motivators that can drive irrational behavior, such as panic selling during a market downturn or chasing high-flying stocks. Having a clear, well-defined investment plan and sticking to it, even during volatile markets, is crucial. Not rebalancing. Over time, your asset allocation can drift due to varying returns from different investments. For example, if stocks perform well, they may become an oversized portion of your portfolio, increasing your risk exposure. Regularly rebalancing your portfolio to maintain your desired allocation helps manage risk and keeps your investment strategy on track. Chasing past performance. Just because an investment has performed well in the past doesn't guarantee future success. Many investors make the mistake of buying into last year's top performers, only to see them underperform. Focus on the fundamentals and long-term potential rather than short-term performance. Conclusion. Overall, investing £5,000 wisely requires a lot of preparation. Determining your goal will make your plan clearer and more achievable. Now, there may have been some concepts here that you're not sure of or want more detail on, and you're welcome to post in the comments below. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!